We don't see evidence that monetary policy was the smoking gun. We don't see evidence that monetary policy was the main systematic cause of the crisis. But that's not to say that monetary policy was entirely without blame. Now, interest rates were certainly low in the immediate aftermath of the dot-com crisis, and some say that that was the cause of the crisis. But we think that there are too many exceptions in terms of countries' experiences with asset prices for this to hold. For example, well, we would recommend that policymakers, monetary policymakers, consider taking a broader approach to monetary policy, and that's to say that there might be times, even when inflation is under control, that they should think of what's happening in asset price markets to see whether there are these kinds of financial vulnerabilities building up. And if that's the case, they should strongly consider taking preemptive action and not think that we can just pick up the pieces after the crisis has happened, should that be the case. Well, we certainly acknowledge that taking a broader approach to monetary policy is not going to be easy. And in particular, having rigid and mechanical reactions to simple changes in asset prices is not a good idea. So the challenge for monetary policymakers is to look behind what's happening to asset prices, to try to see whether they're accompanied by the kind of vulnerabilities that can lead to an eventual and costly crash. The second thing we point to is that if policymakers are going to take a broader approach that occasionally requires them to temporarily suspend concern for inflation, that they have to communicate this very carefully. They have to show how their actions are still consistent with the longer term objective of stable inflation and maintaining the value of currency.
We find that banking crises tend to have a long-lasting impact on output. And our analysis of 88 past banking crises shows that even 7 years after the crisis, for the average country, the level of output is about 10% below its pre-crisis level, which is a fairly large number. There is, however, a significant variation in outcome across countries, and this is true for both emerging and advanced economies. But the good news is that while there's this impact on the level of output, banking crises don't seem to permanently decrease the medium-term growth rate. No, the medium-term output losses are not inevitable, and we find that there are many countries that succeed in going above their pre-crisis path. But what we also can say that although the post-crisis dynamics are very hard to explain, we find that economies that implemented short-run macroeconomic stimulus tended to have lower output losses in the medium run. And also structural reform efforts are typically associated with better medium-term outcomes, although there was clearly no one-size-fits-all when it comes to the right policy to implement after a banking crisis.
We've sorted out.
Yeah, which
three graphics. Yeah.
Well, the implications of our analysis are quite sobering for the countries that have experienced recent banking crises. However, we could also say that the very forceful macroeconomic response that has been implemented so far in these countries in the form of monetary and fiscal stimulus may help mitigate these losses. Nevertheless, to the extent that there are lingering concerns about these medium-term output losses, it is also important to implement policies that would boost medium-term output and facilitate the reallocation of resources across sectors.